Hello, everybody. My name is Devadas. I'm the CEO of the Future Moves Group. Welcome to the seventh and final installment in our series on Singapore and the economic crisis. Today, I'll be focusing on projections and some anticipated problems over the midterm. It's going to be a slightly lengthier video than the previous one, but I hope you'll find it useful and interesting. Now, unemployment has been increasing over the period between 2006 to 2019. It's been fluctuating up and down. I showed you that the MOM provisional estimation for resident unemployment was at 3.3% for March 2020. So the question is, where is it heading towards? Again, in the previous video, I did a very crude sort of extrapolation for you, which suggested that the government's looking at the next 6 to 12 month story as being one where resident unemployment may be between 7.5 and around 8%. And those numbers are not small, and they are higher than at the height of the global financial crisis during 2009 and 2010. However, the Future Moves Group's projections are less sanguine than the government's projections. Our estimations are that resident unemployment will be between 8 and 10%. This will be refined as we get more data from the mid-year results. And total unemployment will be between 6 and 7%. Now, one of the things that the government always says is that having a strong presence of foreigners within our workforce helps to insulate the Singaporean worker from the vulnerabilities to retrenchment. Empirically speaking, that is not true. Historically, through the 21st century, all our recessions have shown that resident unemployment has always been higher than total employment. Now, why do we have a projection that is higher than what we guessed what the government projection would be? And this is really for three major reasons. Number one, I think the government's optimism of being able to create those jobs is yet to be proven. So there's a degree of discounting that we introduced into that. Second, that I think that it may have perverse side effects. What do I mean by that? Is that it may actually encourage businesses to retrench or underemploy their current permanent employees and substitute them with these mid-career or new entrant interns because they come with wage support from the government, and therefore unemployment may actually go up while the government's trying to create jobs. This is not necessarily the government's fault, but it can be, as I say, a perverse outcome which can moderate the expectations they have that the creation of these jobs or quasi-jobs will have in terms of moderating the resident unemployment number. The third factor is got to do with geopolitical and geoeconomic trends and indications where we don't see any evidence of growing coordination or even growing awareness of how COVID is transitioning from a public health issue at a global level, it's a global pandemic, into a global economic crisis and then a financial crisis. One of the transmission mechanisms between how it transitions from an economic crisis to a financial crisis may well be the debt overhang, sovereign debt overhang over many advanced economies which borrowed heavily to essentially bail themselves out and bail out large banks during the financial crisis in 2009 to 2010, from which they still haven't fully paid off. And so there's significant potential for sovereign debt crisis to be confronting economies such as Spain and Italy, potentially even France, definitely Greece. And that's going to have a retardation effect on global activity. We also don't know what the full effects of COVID are going to look like in economies which have poor public health infrastructure, such as many economies in South and Latin America and Central America, and in most of Africa. And therefore, I think it's very important for us to be realistic that the global geoeconomic conditions are very unclear and cloudy at this time, and the indications don't support a positive outlook, but support one that is more pessimistic. From a geopolitical point of view, we don't see cooperation, we don't see coordination, we don't see proaction, and we don't see really enough fiscal or capital capacity, even within the combination of the World Bank and the IMF, to be able to sufficiently intervene to prop up economies because of the large number of economies that will require assistance and the kind of scale of assistance that will be required. And I think, therefore, it's going to be quite challenging to see any kind of upside in the near term, which is the next 6 to 12 months. And it's more probabilistic to see downside risks continuing to either restrain or retard recovery over the next 12 to 18 months. Now, again, I want to stress that when we talk about unemployment, we should not forget about underemployment, and I think underemployment numbers are going to be rising significantly as well, as I mentioned in my two previous videos. When we think about the projections for 2021, though, they don't get better. We anticipate a 10 to 12.5% resident unemployment rate, which is at the higher end double what it was at the height of the global financial crisis. And that total unemployment rate may be well within 8 to 10%. And this is after factoring all of the government stimulus and job creation measures. Now, some of the anticipated problems that we're looking at are that the creation of structural unemployment base that is sizable as a result of protracted and large-scale unemployment. Structural employment is described technically as those workers who've been seeking jobs unsuccessfully for 6 months and longer. One of the challenges of having a large structurally unemployed base is the longer they stay unemployed, the more difficult it is for them to fit into the workforce, even when there is a recovery. That's a statistical and empirically demonstrable fact. But we have a new phenomenon, which is that as we increasingly become a digitalized economy, and it's increasingly businesses look to save costs by turning to the adoption of artificial intelligence and machine learning and software to substitute cognitive labor. And we are already a services-based economy. 65% of our economy's GDP is contributed by services. What we may find is that the structurally unemployed cannot fit into the workforce, not because they're being substituted by foreign talent, as may have been the case in certain past crises, but because they've been substituted by software. And then dealing with the legacy effect of having a large structural employment base of, say, 3 to 4% of our total workforce is going to be a social and political challenge, not just an economic one. And it's going to require us to relook at our social support systems and rethink certain principles and ideologies in which we have underpinned those social support systems historically. Now, this is a picture that doesn't have any numbers in it, and it shows a pig flying through a ring of fire. I wanted to show this picture because I want to talk about the action of equity markets versus what's actually happening in the real economy. Equity markets have been rallying and show signs of continuing to gain strength. And I'm talking about leading equity markets, not slave equity markets like Singapore. By slave equity markets, I don't mean that we hire slaves here. I mean that our equity market essentially takes its cue from the NASDAQ, takes its cue from the NYSE, takes its cue from the FTSE. It doesn't necessarily act in most cases because of internal domestic action. Now, the question behind why these markets are rallying despite the evidence of economic contraction in their own economies as well as in the global economy as a whole is a very important one. And one part of the answer is essentially the action by the Federal Reserve, but also by other central banks to lower interest rates, to print money, especially in the case of the Federal Reserve. And this is making capital cheap and accessible to institutions, not to you and I as retail individuals, but to institutions which, instead of taking and putting into productive infrastructure that has long-term payoffs, relatively lower margin payoffs, they're taking it and putting it into speculative action, which of course is the futures market, is the equities market, is the derivatives market. And so you see an injection or steroid injection of capital as a direct result of central bank policy decisions going into the equity market and therefore driving them in a diametrically opposite direction from what's actually happening in the real economy. I think it's really important for individuals to understand that the equity markets are therefore not what you would have maybe heard of in theory or been told by your stockbroker that it's a leading indicator of the economy. It's not. In fact, it's not even connected in reality to the economy anymore. And but of course, if you've got money to lose and you enjoy a good punt, you're more than welcome to join in the game. But institutional actors, keep in mind, have that access to cheap capital at large volumes. They also have asymmetrical informational advantages over you as an individual. So if you think you're smarter than them, you're wrong. And they also have the benefit which they learned from 2009 to 2010, that the more that they participate into speculative action and therefore run the greater risk of screwing up or blowing up, the higher the likelihood that the government will come and save them. And that was a moral hazard that was created in 2009 and 2010. The government did not come and save. When I say government, I mean governments in general, not the Singapore government in particular. Governments, especially in the United Kingdom, in the United States, in Spain, in Italy, in France, and in Japan, stepped in to save their large financial institutions in order to try to contain the destructive fallout from systemic failure of the financial sector. And this moral hazard, I think, has encouraged the behavior of financial institutions today, and will continue to inform their behavior over the next 12 to 18 months. And so it's a perspective as well as a warning that I'm providing to you, couched as advice, to an individual as well as perhaps a small investment houses, that this is a game that you may not want to play. And if you do play, you're unlikely to win. But that's just free advice that you can take on board for your own purposes. So at the end of this 7-part series, what are the takeaways? First of all, I think we need to distinguish between foreign talent, which refers to the highly skilled professionals, and foreign worker, which refers to semi or unskilled labor. We need more foreign talent and much less in terms of foreign workers. And you've heard me talk about trying to contract the foreign worker workforce by as much as 50% over the next 5 years. But increasing foreign talent should come with increased quality control barriers, by which I mean that from a policy point of view, the hurdle rate for what qualifies as foreign talent in terms of credentials, in terms of experience, in terms of being able to show empirical evidence that you can provide value to our economy have to be more rigorous. And wage as a proxy indicator of this should not be used as the primary decision matrix by the MOM to decide whether to award employment passes. For two reasons. One, it is, while theory suggests that it's a price signal, that if businesses are prepared to pay that X amount of money, this person must really be good, is not actually, I think, necessarily proven. And secondly, there is gaming in the industry where some businesses may well be declaring that they're paying this amount to their workers, but then clawing it back through other means. We need to reduce our dependency on foreign workers, and that has to be done through increasing capital productivity by making significant investments in technology, adoption of new work processes, different kinds of I think organizational models as well in project management, particularly in construction, but also in the cleaning industry and in the lower tiers of the services industry. I think we really have to ask ourselves how we're going to manage a large and sizable structurally unemployed base. And that's going to require us to relook at our social support systems, as well as investing disproportionately in the structurally unemployed in order to ensure they can be reskilled and upgraded and are more able to refit back into the economy. And this may require some financial incentives to be provided to businesses, but it's essential that we do so. And here I'm referring to the structurally unemployed residents, which is Singapore citizens and Singapore permanent residents. I think we owe it to them. I think it's going to be important. And by investments, I don't mean sending them for 3-day courses where they learn about Edward de Bono's 7 hats or how to make friends and grow their influence. I'm talking about potentially going back to 6 to 12 month long training courses or even longer to really get retooled in order to be able to refit and be relevant to the economy. We also have to manage the expectations of new entrants who are going to find it difficult to actually enter the workforce in the first place, because that workforce is going to contract. It's going to take longer for them to search for jobs. Some will be lucky because they have perhaps certain specific unique talents, or others who are lucky, who are prepared to take much lower wage levels. But they're also going to perhaps have to accept that they have to take jobs which are less than their desired fit. So for all those who have dream jobs that they've been working towards, let me put it to you in a different way. It should now be your dream to have a job rather than to have a dream job. Because it's empirical evidence, not only in the Singapore case, but many labor market studies, that the longer you stay unemployed, the less employable you become. And if you choose alternative employability in terms of things like becoming a Grab driver or a Deliveroo driver, in lieu of putting the skills and the knowledge that you have been equipped with through your public education to use, that skill and that knowledge base becomes obsolescent, and your alternative jobs don't add any new skills or knowledge to you. So you become less relevant to the economy over the longer term. And it's important that you face up to these realities And Singapore today is very different from the 1980s, or even from the end of the 1990s when I entered the workforce. I had to take the jobs that were available to me. We didn't have the luxury of affluent families to pay internet bills on broadband so that we could improve our scores on Warcraft. We had to do what it took to get employment and to help to support ourselves and lower the burdens on our families, or if necessary, support our families. Today, Singapore has a very large middle class, and I think it's important that we understand that even the ability, though there's the ability to support our children financially, until such a time that they can achieve their dream job, we may be doing them a tremendous disservice and creating a tremendous moral hazard, and also making them creating a bubble that insulates them from the reality of what the economic world really looks like, and ultimately making them less competitive, because Singapore's future is a future where we are going to have to be more internationally competitive, not domestically or regionally competitive, and that includes our wage market and our labor market. And unless our young people are equipped and have a reality check, I think no matter how much the government does, with how good their intentions are, I think that we set ourselves up really for a long-term path that is less confident and less optimistic than one that we can have if we equip them, our younger people, with not a bubble, but a reality check. And for those of you who are interested, you can go to my LinkedIn page and find an open letter to career counselors at universities and families and friends, where I speak very frankly about what these realities are. Finally, we are also going to have to deal with our seniors in the workforce. The government's put in a tremendous amount of effort to retain and to boost re-employment of seniors in the workforce. This is very creditable on their part. Unfortunately, seniors are the most vulnerable to retrenchment during a crisis, and they're also the least likely to be re-employed. And so unfortunately, I think all the progress that has been made in boosting the employability of seniors is going to be unwound over the next 18 to 36 months. And there may be nothing the government can do in the short term to restrain or to reverse that. However, I think when there is a recovery, I think there are historical efforts should be renewed, and I think we can look forward to a time where the positive gains that we've made over the last 10 years in boosting the employment of seniors will be something that we can return to. But we're going to have some sense of reality about how this particular demographic is going to be impacted over the next 12 to 18 months or longer. Finally, as I mentioned in my previous slide, if you want to play poker with the markets, whether it's equity, forex, or even the property market, and you can't figure out who the sucker is, it's probably you. Because in all of these speculative games, for somebody to win, somebody's got to lose. And so I advise you to act with caution. I advise you to be humble about your ability to really compete with institutional players, and to do so on a kind of long-term basis, and also to be very careful about the kind of risk that you take, because leverage will become more easily available as capital is flushed into the system, into the financial system, both international capital markets as well as the Singapore capital market. And so the temptation to be able to leverage in order to try to increase your gains can also work against you and magnify your losses. So that's a final piece of advice which you can take as professional or as personal advice, but it's for you to take on board. Now, in part one, I talked about what the potential recovery will look like. Well, it's definitely not going to be a V-shaped recovery, which was a characteristic of our recoveries in the 1980s and 1990s. I don't think it's going to be a U-shaped recovery, which is more optimistic than a V-shape, but it has this sort of a temporary period of maybe 3 to 6 months where we have a very low economic activity, and then suddenly we accelerate. I don't think that that's going to happen either. I think the high probability is that we may have an L-shaped pattern of economic activity. I choose not to use the word recovery in this instance, where we have economic contraction and then we have a stabilization at a lower economic point, and we stay there for potentially 24 to 36 months while we wait for the major economies of final demand that we depend on to service to recover, because 75% of our GDP is trade weighted. There is a possibility that we have a kind of sine curve recovery, which is where we have the sharp decline that we're already in and continue. We have what's the illusion of a V-shape, but it's very temporary, and it's off a low base. Now, the thing to keep in mind is to differentiate between absolute number recoveries and percentage-driven recoveries. Percentage-driven recoveries are all relative. So the lower your starting base, the smaller the absolute volume of actual economic dollarized improvements has to be in order to give you a higher percentage illustration of a recovery. So you could have the illusion of a V-shaped recovery, but then stabilizing very quickly at a plateau of a very low growth or neutral growth. So the L and the sine curve in combination are what I expect to see the Singapore economy go through definitely over the next, or a very high probability over the next 12 months, but potentially over the next 18 to 36 months. Now, after that, I think we may enter into a market or economic situation where we have a high frequency volatility as the world tries to figure out what the future, longer term future looks like. And volatility here is going to be driven by factors other than economic. They're going to be affected by geopolitical trends as well. They're going to be affected by long-term economic destruction, especially the SME substrata of economies, not just our economy, but major economies, that's going to take time to rebuild. That's going to also reflect limits to fiscal policy intervention that governments can do. What they're doing now and what they're able to do in 2 to 3 years' time may be very different. And given the aggressive action already taken by the Fed, there's very limited space for monetary policy action by the major banks, whether that's the Federal Reserve or the ECB or the JCB, the Japanese Central Bank, or the POBC. And so we will run out of fiscal space and run out of monetary policy space, and it will take time to rebuild businesses. As I mentioned in one of my first videos, business failures and job losses can happen quickly. Business creation and job creation happens slowly. So when you take all these together, you can end up in a situation where you have subpar growth for quite a long period of time, and that subpar growth can be characterized within the context of volatility. So you may not have stable subpar growth, but volatile subpar growth. Finally, I think it's also really important to appreciate that the COVID crisis, in combination with geopolitical factors that were already present and contextual, are going to lead to a reshaped world order. And that is a topic that goes well beyond this particular series, but that world order is going to be the context in which the global economy has to play. New rules, new conditions, new boundaries, new leadership or absence of leadership, potentially less order and more disorder. So we may be going from world order to world disorder. And all of this is going to have consequences in the 3 to 5 year and beyond outlook. And I think this is, again, something beyond the scope of this particular series. It may be something that I address depending on how well this 7-part series has been received. But if you have comments and thoughts, feel free to share them with me. Now, this brings me to the end of the 7-part series. As I've mentioned, please share with us your feedback, either on my LinkedIn page or the company LinkedIn page, or at our email, contact us at futuremoves.com, or on our YouTube channel. We've received demand to repost the 3 videos that preceded the 7-part series, and we will do so over the coming week. And again, in relation to those videos, which were, I think, one, a quite lengthy video which took an overview on how COVID-19 was impacting us as a country. Second, looking at economic paradoxes to do with the Singapore economy. And third, specifically challenges to SMEs. And hopefully those videos, when they're reshown, will also be of benefit to you. Finally, let me conclude by thanking all of you who took the time to view the videos and to share your comments and to give me encouragement and the company encouragement. For those of you who don't agree with some of my views or our views, or who have different perspectives on projections or prescriptions, that's perfectly fine. We don't require agreement in order for us to have I think connections on LinkedIn or connections as companies. In fact, I'm hoping that what the total series of 10 videos does is catalyze debate, catalyze discourse on important questions, illuminates certain darker corners of the economic and political space that may be in the shadows, primarily not because it's being hidden, but primarily because the focus is really on the here and now and not on the future, and not on the ancillary issues that are surrounding us. And ultimately that some of the ideas and recommendations and cautions and advice prove useful to you. And even if you choose not to adopt them, that they become ingredients in the way in which you think through the problem, and ultimately lead to you making better choices for you. Because one thing and a note I want to end on is that the motivation for the Future Moves Group to undertake this series of 10 videos was primarily to help households, workers, micro SMEs and SMEs who can't afford expensive consultants or to buy expensive reports, to better understand the complexities and complications that we are facing here in Singapore and globally, and what to expect over the longer term, up to a 5-year at least outlook. And I hope that that's been of benefit to you, and we genuinely wish you all the very best, and to stay well and to stay healthy. And on a personal basis, I thank all my connections for reading my posts, not just the videos over all these years, and actively commenting and participating and engaging on the topics of the day. And I hope that that will continue, and I encourage more of you to contact and connect with me in order for us to be able to strengthen our ecosystem of knowledge and professionalism, and also build, I think, human relations that even in a time which is going to be defined more and more by technology, I think it becomes much more imperative, much more important for us to have those human connections, because at the end of it all, I think, as John F. Kennedy reminded us in 1963 after the Cuban Missile Crisis, in a speech he gave, that in the final analysis, we really all want the same thing. And to paraphrase him, that's a better future and a safer future for our children, and better lives for future generations. And with that, thank you, and I wish you all the best.